If you're getting into UK property investing, one of the biggest questions is to whether to buy in your name or through a limited company. A lot of people online make it sound simple. They'll always say, buy in a company or don't buy in a company. But the truth is, it depends on your tax position, your long-term growth, and whether you actually want to grow a portfolio or just buy one or two properties. So, in this video, I'm going to explain why I've decided to use a limited company for my next property purchase, what pushed me in that direction, the extra costs, the pros and cons, and why this does not suit everybody. Quick disclaimer before we get started. This is not financial advice. I'm literally just sharing my own situation and research behind my decision. If you're thinking about doing this yourself, speak to a qualified accountant, mortgage broker, and solicitor first. Okay, so let's talk about my personal situation first. So in my case, I already own one buy-to-let property, and that's in my personal name. And I also have another job on the side, which gives me a salary of about £40,000 per year. So this matters because when you combine salary with rental profit, the tax starts to matter so much more. So I'm also trying not to buy just one property and stop there. My goal is to build a portfolio over time, which means I have to think about structure, not just the next deal. That is the real reason I started looking at limited companies. So let's talk about what a property limited company actually is. So in simple terms, a property limited company is just a standard UK limited company that owns the property instead of you owning it personally. The company then receives the rent, pays the expenses, pays the tax on all of its profits, and you can register the company online, and the fee is £100 to do this. On top of that, there is an annual confirmation statement fee of £50 if filed online, and the company must also file annual accounts. So straight away, the idea that it only costs a few quid to set up is outdated. The filing alone is £100 now, and that is before accountancy, legal work, and mortgage costs. But there is a main tax reason why people want to use a limited company. The big attraction is how finance costs are treated. If you own a residential buy-to-let personally, HMRC restricts finance cost relief to the basic rate of income tax. HMRC's own wording is that relief for residential landlords' finance costs is restricted to basic rate. Inside a company, mortgage interest is generally treated as business expense before tax is calculated, which is why portfolio landlords often find the company route more attractive than owning multiple mortgaged properties under their own name. Tax rates are 19% for profits under £50,000. That does not automatically mean the company route is better, it just means the tax mechanics are different. So I know this is all really confusing. So let's do a beginner's example. Let's say a property brings in £12,000 per year in rent and has a large mortgage bill. Personally owned, the tax calculation can be less favourable than people expect because the finance cost relief is restricted. Whereas if it was company owned, the mortgage interest is genuinely dealt with inside the company accounts before tax is charged. That difference becomes more important the more leveraged you are and the more properties you plan to hold. This is the point where a lot of investors stop thinking about just one deal and start thinking about long-term structure. So let's talk about why I'm personally doing this myself. For me, the limited company route makes more sense because I want to keep growing, not just sit on one property. I also don't love the idea of building a larger personally owned portfolio and then realizing later that the tax drag is far heavier than I expected. I'd rather set up a structure properly now for future purchases. I'm not saying everybody should do this. I'm saying that for my income level and my long-term plan and the fact that I want to scale, it makes more sense to invest within the company. So I thought it might be a bit easier to do a comparison between buying a property through a limited company or buying it in your personal name. So let's look at a simplified example so that you can see how the numbers might differ. Imagine a typical buy-to-let property with the following numbers. The purchase price, £160,000. The mortgage, £120,000. The interest rate at 5%. The annual rent at £960 per calendar month. This means a yearly rent of £11,520 and annual mortgage interest of roughly £6,000. Let's assume other costs like insurance, maintenance and management come to about £1,500 a year. So the true cash profit would be £11,520 rent minus £6,000 interest minus £1,500 extra costs, leaving approximately £4,020 profit. Okay, so I'll do two examples. The first example will be if the property is owned in your personal name, and the second example will be if the property is owned in your limited company. So, if the property is owned in your personal name, mortgage interest is not fully deductible. Instead, you receive a basic rate tax credit on the interest. So the taxable profit calculation looks different. You are taxed on the rent minus the non-finance costs. So in this example, you get £11,520 rent per year minus the £1,500 costs, and the taxable profit is £10,020. Now, if the landlord is a 40% taxpayer in the UK, the tax would be roughly £4,008. Then the finance cost tax credit reduces the bill. The tax credit is 20% of the £6,000 interest, which is about £1,200. So the final tax bill becomes roughly £2,808. Now, if we take the actual tax profit of £4,020 and then subtract the tax, which is £2,808, the real take-home profit becomes roughly £1,212 per year. So let's do the figures again, but instead let's do them as if you are buying the property through your limited company. So inside a company, mortgage interest is treated as a normal business expense. So the calculation becomes much simpler. So let's say you get £11,520 rent, minus £6,000 mortgage interest, and minus £1,500 extra costs. Your profit would be £4,020 per year. But if the company falls within the small profit rate of 19%, you get this if the company is earning below £50,000 per year, the tax would be roughly £764. This would then leave around £3,256 profit remaining in the company. However, you need to remember, the property is still inside the company. If you withdraw it personally, further tax could apply depending on how you take it. Okay, so let's see how these figures would work if you had multiple properties. Now imagine you own 20 similar properties, but you own them in your personal name. So you're getting approximately £1,212 a year per property. So if you had 20 properties, that would be about £24,240 a year after tax, which doesn't sound a lot for 20 properties. Whereas if you own these 20 properties in the company, each property would generate you approximately £3,256 per year. So times that by 20 properties, and that is £65,120 retained in the company. That is a huge difference. And this is one of the biggest reasons portfolio landlords use limited companies. They want to keep more money inside the business to buy more property. But obviously there are downsides to a limited company. So let's talk about the negatives, because this is where a lot of YouTube videos become way too one-sided. First, a limited company buy-to-let mortgages are often more expensive, and there are usually less choices. Personal mortgage rates are typically lower than those offered to limited companies. Mortgage fees tend to be higher for company mortgages, and the choice is more limited. Secondly, legal work can be more complex. That's partly because lenders often require the director of the company to sign a personal guarantee. The British Business Bank says many lenders require business owners to seek legal advice before agreeing to a personal guarantee, and some require a solicitor to confirm that independent legal advice has been received. That matches my own experience. Even though the mortgage is in the company's name, the lender that I use personally still wants personal backing from myself, the director. So yes, the company gives a different tax structure, but no, it does not remove personal risk in the way some people assume. And there is a lot more admin. Company house requires annual accounts and a confirmation statement. That means more paperwork and in many cases, more accountant involvement, which means more money going out of your pocket. So if you have a couple of buy-to-let properties or plan to buy more buy-to-let properties, when does a limited company make sense? Like broadly, a limited company becomes more attractive when you expect to buy many more properties, or you are using mortgages heavily, you are thinking long term, you plan to reinvest profits rather than spend them immediately, and your personal tax position is already becoming less favourable. That does not mean a company is always right. If you only want one property, less borrowing, and minimal admin, personal ownership might still be more simple for you. But for me personally, what I am trying to achieve is my aim is to build a proper long-term property business, not just dabble. That means I care about tax efficiency, scalability, reinvestment, and have a structure that can support more than one or two properties. For me, the company route is part of thinking bigger and thinking longer term. Not because it's trendy, not because some guru on the internet says always use a company, but because when I actually look at the tax rules, the mortgage interest treatment and my future plans, it starts to make much more sense. So the absolute honest conclusion, guys, so why have I started a limited company for property investing? Because I want structure that better suits long-term portfolio growth. Because personally owned mortgages properties become less attractive as tax starts to bite harder. And because companies can deduct mortgage interest in a way that individuals can't. But also because I've accepted the trade-offs. I understand there'll be more admin, there'll be higher mortgage costs, there'll be more legal complexity and personal guarantees that can still put me on the hook. But at the end of the day, it is just a business strategy that I am personally using. And for me, right now, it feels like the right one. So if you're interested in following the full journey as I grow the portfolio, please subscribe, because I'm going to document the real numbers, my real decisions, and the real mistakes as I go.